Good morning, good evening if you're in Asia, and welcome to the benhamandreeves Property Power Hour. We're just waiting for a few more people to join, and so I want to let as many people have the opportunity as possible. So I hope you're okay and could just hang on for another literally couple of minutes, and then we'll start immediately, and it'll only last for an hour. And I hope it'll be an interesting session for everybody. Thank you. Hello everyone. Thank you to so many of you for joining us today. And we've actually got attendees from 30 different countries. That's what I was just doing in the background, looking where people have come from. 30 different countries have joined us right now. So welcome to everybody. I'm Mark von Grundher. I'm a director of benhamandreeves. And this is our very first webinar in this brand new series that we're calling the Property Power Hour. It's going to be hopefully a packed 60-minute session during which we'll explore the intricacies of the London property market and how to maximize wealth creation from this very safe haven investment. So I'm going to start this morning or this afternoon, depending where you are, with a focus on why London, and then give some of my own tips to help you make the most money possible. After I finish, my co-director Vida, who runs our accounts and is our finance director, will join and provide an overview of the buying process, relevant taxes, and how we at benhamandreeves can help you avoid the pitfalls and ensure you make the most money possible. And after Vida, Conor Murphy, who runs Capricorn Financial, which is one of the UK's largest mortgage brokers, will join us to give you some insights into the financing options available. And then at the end, we'll hold a Q&A session to answer as many of your questions as possible. So please do feel free to send in as many questions as you like using the Q&A function, not the chat function, the Q&A function at the bottom of the screen. So let me start. There's no doubt that we're living in unprecedented times. Investors from around the world are desperate to find a safe place for their money. And one of the key places is property. Property has historically been and continues to be a more rewarding investment than typical alternatives. It's a tangible investment, and people are always going to need a home. On top of that, London has always been a safe port in the storm. Historically, whenever there's been a global crisis, people have flocked and today continue to flock to London because investing in London is an option open to everyone the world over. So the key question is, why London? Well, the answer for me is obvious. London has long been a sanctuary. It's survived recessions, terrorism, financial crises, and it will survive the current pandemic. We have a powerful media, business, and cultural hub here with a skilled and dynamic workforce, arguably the world's strongest financial services sector. And it's a key global center for education too. This cosmopolitan global city remains in the top places in the world to do business. Pause for a minute and look at the long-term picture. According to the Office for National Statistics, the ONS, the average London house price in 1991 was just over 70,000. Look at the last 3 decades, and at the end of 2021, the average price was almost £520,000. That's an 86% increase in 10 years, but a 298% increase over 20 years, and an eye-watering 600% over the last 30 years. The figures tell the story here. Even in the most politically and economically difficult of times, London property remains a valued and appreciating investment. London's extremely resilient, and no more so than now. The London property market is underpinned by strong fundamentals. And I'm certainly not saying that the property market is immune to COVID. However, it has recovered very quickly. And that's both in terms of rentals and sales prices, as people are always going to need a home and somewhere to stay. In fact, this heat map by Zoopla, one of the UK's largest property portals, is interesting in that it demonstrates how property prices across the UK have recovered from the 2007 peak. You know, as you can see, the highest growth here is restricted to London and the southeast, where it's in red. That shows that. I always refer to London property as a bulletproof investment, for long considered one of the world's most trusted assets. With its ability to drive a regular income and long-term capital growth, especially during times of wider uncertainty. In fact, UK house prices rose at a faster rate in 2021 than in any year since 2004, and that's according to the Halifax. For overseas residents, London property creates an opportunity to invest away from your local market. As any banker will tell you, diversification is a cornerstone of any good investment portfolio. The cost of borrowing is still close to an all-time low at 0.25%. That's the Bank of England base rate. Even a marginal increase is unlikely to dent the appetite for home ownership. And with cash actually losing value in real terms that's left on deposit, in my opinion, there's only one place for it, and that's London property. But it's still important to target your investment. Apart from price and location, you need to consider yields, potential for capital growth, whether it's in a regeneration area, and the reputation and track record of the developer. Our role is to help you make the most money possible by maximizing the return on your investment, which includes saving your valuable time. To invest at a time like this is not easy, but history is our friend here. The keys are clear thinking, meticulous planning, on-the-ground knowledge, and a trusted independent partner. Honestly, the most important of these is having someone independent you can rely on and trust. Someone who will hold your hand, guide you through the process, avoiding pitfalls along the way. It's also absolutely crucial to be ready. And by that I mean having everything in place so that the moment you find that right opportunity, you can pounce on it. That not only means working out your budget of how much you want to spend, but also working out your finances and ensuring they're sorted out early. And Connor can talk about that later. But what is that opportunity? Well, this is where it's essential to maintain a degree of perspective. Remember, if you're buying as an investment, this will not be your home. It'll be a home for someone else to rent from you. And so the key is to consider, who are they going to be? What are they going to want? And what are they going to be willing to pay? Please remember that you buy a property for investment with two goals in mind: capital appreciation on the one hand, and I'll repeat the same advice I gave to clients back in 2000 and in 2010. Don't buy a property you expect to sell within 5 years. You know, that's called flipping, and that flipping strategy, i.e. selling before completion for a short-term gain, is very dangerous. There might be a big fast recovery, but I always recommend taking a longer term view. And don't forget, the other goal is rental yield. And with 1/3 of London households currently renting, which is expected to climb to 60% by 2025, supply of rental stock is unable to keep up with the demand, making rental yields of 4 to 5% very achievable. And then when you factor in interest on cash in the bank at effectively zero, or worse, when you account for rising inflation, 4 to 5% is actually really appealing. So now turning to the all-important question, where and what to buy. So take a look at this map. There are 32 London boroughs. London is really diverse. The enormous capital growth in the centre has left yields very low there. But if you look a little further out, where prices are much more affordable, yields are much higher. And in fact, this map shows you price growth in the different boroughs over the last 20 years. In recent years, areas on the outer fringes in zones 3, 4, and even 5 have outpaced growth in the prime London postcodes, as Londoners increasingly seek homes with more space on lower budgets. Although every investor has different requirements, it's our job to help you find a property that, frankly, I'd invest in myself. And that means ticking a number of boxes. Affordable, meaning that yields remain relatively high. Excellent transport links. Access to green spaces. Close to schools or centres of education. And by a reputable developer. So now let me show you a few examples of how property has performed, showing the returns that we've achieved for our customers in recent years. So the first one is in Notting Hill in central London. It's a one-bedroom flat that we purchased for a client in 2014 at £460,000. It's now increased in value today. We had it valued just before Christmas, and it's about £630,000 now. The annual rent's £26,500. That's giving a gross yield of 5.76% on the original purchase price. Now, where this becomes interesting is your return on cash. If you didn't take any finance and you paid it all in cash, your return on cash would be 36.9%, which isn't bad over an 8-year period. However, if you had finance and borrowed 70%, your return on the cash deployed would be 123%, which is pretty amazing. The second example is actually a flat that I bought myself. It's in Tooting. I followed advice. We had 8 investors who joined me and bought here. It's a one-bedroom flat in Tooting, southwest London. And I paid £320,000 in 2015. Last valuation I had was for mortgage purposes was back in October last year, was at £475,000. My rent is £18,660. It's giving a gross yield of 5.83%, which is great. No finance. If I pay cash, which I didn't because I borrowed 70%, I'd still get almost 50% return on my investment. But with finance, and I borrowed 70%, I've had a return of 161% on my money deployed. That's pretty impressive by anybody's calculations. The next one's in Stratford. It's in E15. It's near the Olympic Village. It's going to be on Crossrail. It's in Stratford. It's a 2-bedroom flat. It was purchased in 2015 for £365,000. Current value is £585,000, and the annual rent is £23,400. Again, a gross yield of 6.4%. Without finance, 60%. And I'm sure you can now see how the model grows. If you had finance, it would be 200% on your original cash. I now go to the west, to Ealing. I think you'll see a trend here. I'm taking one in the center, one in the south, one in the east, one in the west, and the last one will be in the north. We did one in Ealing. It was a studio. It was bought in 2012, so just under 10 years ago. £280,000. Current value is 450. Ealing has seen amazing growth because it's been in a regeneration where this scheme was. The yield is 5.57%, which is pretty good on on cash. Again, 60% return if you sold it and you paid 100% in cash. But with finance, again, just over 202% return on your capital deployed, which is amazing return on investment. The final one, as I said, is in Northwest London, in Colindale, a development that we love called Beaufort Park. It's a 2-bedroom flat. It's a regeneration area. It was bought in 2008. So you can see each of my examples are different timescales. So I haven't just tried to skew the figures. These are actual live examples of things we recommended. It was a 2-bedroom flat. Longer days, you could buy one for 250, but it was bought for £250,000. Current value was at the tail end of last year, 450, and I think that was a little bit mean. I'm sure we could probably achieve a little bit more than that. Still, with the rent, it's 8.24% on the cash, on the investment price. Without finance, the return on cash will be 80%. That is 14 years later, but it's pretty impressive. But with a 70% loan, that's giving a return on someone's cash, on your cash, of 266%. So there's just some examples of what we've been able to achieve, as I said, by investing, in the right property, in the right area, with key local knowledge. And I think you'll agree, well, they still make me amazed how well they've performed, and they are really quite remarkable. So I really hope that was helpful. I've run over a little bit. I've talked for almost 50 minutes, which is a bit long. So I'm now going to pass over to my fellow director, Vidamera, who'll talk you through the buying process and how Benham & Reeves can help you make money. Thank you very much. Vida?
Thanks, Mark. So buying a property in London can be the opportunity of a lifetime. If you're based overseas, it's important to point out that there are no legal restrictions on international investors buying property in the UK. So if you are able to secure a mortgage or have the funds available to make a cash payment, the buying process can actually be quite straightforward. This slide outlines the various steps involved in buying a London property. So let's assume you're buying in a new development, off plan. Once we have helped you choose a property, you are able to register your interest and secure it by paying a reservation deposit. We will help you negotiate the best possible deal with the developer. This deposit takes the apartment off the market. You will then need to instruct an efficient and experienced solicitor to proceed with the conveyancing process, and you can expect to exchange contracts within a month. At the point of exchange, you will typically be asked to pay 10% of the purchase price. The completion date will then be around 1 to 2 years later. You will be notified when the property is ready, and you will have time to send your balance. Your solicitor will do the rest. And your house keys will be available to you, your agent, or perhaps even your tenant on the day of completion. If you happen to be buying an existing apartment, which is already up and running, we can help you identify the property, negotiate the price, instruct the solicitor and mortgage advisor, and complete the best deal for you in the shortest possible period of time. Traditionally, estate agents tend to work for the developer or vendor selling a property, and once they've made their commission, they disappear. We, on the other hand, are there from start to finish. Once you find a property you want to buy, we can help you furnish it, market it, negotiate with tenants, and manage it into the future. The better the return on your investment, the better our relationship. We have 60 years of experience in the London market and 19 London branches, plus 8 more internationally. We were the first 25 years ago to open offices for our clients in Hong Kong, then Singapore, Malaysia, Shanghai, and we now have 3 in India and new ones in Dubai and South Africa. Today, we have clients across the globe, and I believe they choose us because we are always happy to advise them against buying if we don't think it's right. At a time like this, when everyone is desperate to earn money by selling, it's crucial you take advice from someone who is prepared to say no, while still providing a holistic service that includes everything you need. We offer a full one-stop service. Investment advice, what to buy and where to buy, handover and snagging, furnishings and refurbishment, lettings, property management, and even filing your tax returns. Another unique difference is that that's all our directors and senior people, often invest alongside our clients in the same developments and locations, putting our own money in, clearly demonstrating our belief in what we recommend and using the exact same research process. From Beaufort Park in northwest London to Imperial Wharf in the south, to London Dock in the east, and most recently the Green Quarter in the west, we've invested alongside our clients, and it's worked out very well for us all. I'd like to take you through 2 examples of recent investments that have proved to be very successful for us and our clients. The first is in the Green Quarter, a project in which I personally invested. This is one of London's most ambitious regeneration schemes by Berkeley Homes, who are famous for placemaking and building superb homes in regeneration hotspots. This all translates into capital appreciation for investors that buy into the vision, particularly those that buy in the early phases. I purchased this 565 square foot, 1-bedroom apartment on the 7th floor for £357,000, plus £15,000 for a parking space. Meanwhile, benhamandreeves have just sold a similar 1-bedroom at the latest phase, a 545 square foot 3rd floor apartment. The developer asking price was £420,000 without parking. We agreed to £391,000, so on a pound per square foot basis, the agreed discounted price is still 13.5% higher than what I paid. This shows what's possible by using a good agent, but it also shows how regeneration benefits investors. Here's another example of a successful investment in a regeneration project at Clarendon in North London, again by the Berkeley Group. This Manhattan studio on the 3rd floor with a purchase price of £345,000 after a 2% discount, completed in March 2021 at the height of the COVID uncertainty. Our sister company, InStyle Direct, furnished the apartment, which was fully let to a professional couple within 2 weeks of the owner collecting keys. Now, in the latest release, a similar Manhattan on a lower floor has an asking price of £390,000. Even if we were to assume a similar 2% discount, that works out to £382,000, which on a pound per square foot price is 15% higher than what our client paid in the first phase. These examples just show what is possible with careful, thoughtful investments backed up by local knowledge and the right property partner. I'd like to conclude, as promised, by giving you a quick overview of the relevant taxes. If your property is making money, then there will inevitably be tax to pay. Stamp duty is tiered from 0% to 12% of the purchase price. There is an additional charge of 3% if you own more than one property, and another 2% for overseas investors. Income tax will be approximately 20% on your net profit. If and when you sell the property, you will become liable for capital gains tax, which will be between 18 to 28% of the profit you make on the sale. If you choose to buy in a company, you will also be liable for the annual tax on envelope dwellings, or ATED. Vitally, it is only payable where the property is not leased out. If the property is not let, an annual charge is payable on a sliding scale. It's also important to note, an ATED return must be submitted annually, and that's even if the property is leased and there is no charge to pay. And finally, there is inheritance tax, or estate duties, where 40% of the net estate becomes liable on death. But the first £325,000 is tax exempt, and IHT can be avoided with careful planning. I am wary of trying to go into too much detail at this point. The big picture summary is that one cannot underestimate the importance of sensible tax planning. The correct advice will ensure that you make your investment in the most tax efficient way. And depending on the amount you're investing and making, the right solution could save you a fortune. We do provide our landlords with a comprehensive tax service, down to completing the relevant forms for your tax return. Thank you. I'm now going to hand over to Connor from Capricorn, who will take you through the ways to finance your purchase.
Good morning, everybody. Thank you, Vida. Thank you, Mark. Good morning. So I'm Connor Murphy from Capricorn Financial. I've got a fairly brief presentation for you this morning. I'm going to go through 3 areas. So I'll start with a quick introduction to myself. I'll then go through a few slides on Capricorn, just so you know who we are. And then I will dive into mortgage and finance side of things, including aspects relating to tax and anything that has a financial impact on your property purchase. So if you can please tab on to the next slide. So I'll just start with myself there. So Connor Murphy, I'm the CEO and founder of Capricorn Financial. We're actually the largest mortgage brokerage in London. And then in addition to that, I'm also the CEO and founder of a company called Smarter 365. It's actually a mortgage software platform, and it's the largest software platform of its kind in the UK. And we actually have over 3,500 brokers up and down the country who use the Smarter platform. If you can please tab on to the next slide. So moving on to Capricorn then, more specifically, so we're, as it says there, we're London's largest broker. We actually have 60 plus advisors. I won't read out all of the various bits on there, but we've been in this market for a long time, and we have offices around the world, and we will lend £2.2 billion plus this year. And in lots of the markets in which we operate, we are the #1 brokerage firm, which gives us access to certain exclusive deals and service exclusives in terms of how we get the process to go through for our buyers. You can read the other points on there. In terms of benhamandreeves, we've been working together now for over 10 years, and that's both in the UK and internationally. If you can please move on to the next slide. This gives you an overview of the products that we offer. So we do the full range standard mortgage products. We have a private banking team, we have a commercial team, we have an international team, and we also do things like bridging finance, short-term funding, Islamic finance, self-build finance. So we're very rare in the marketplace, I think actually unique in the sense that we do offer products across every area of mortgage finance. So whatever your individual needs are, I'm certain that we'll be able to help. If you could please move on to the next slide. So this just reconfirms the previous point that we have a much broader range of products than other brokerages have. The technical term is that we have a dual AR status, so we're able to advise on all the regulated ends of the market in terms of residential finance, right the way through to the commercial end, and everything in between, so bridging specialists, etc. yeah, if we can please move on to the next slide. This just confirms again our specialist services, the international team, and that's focused predominantly on any buyer who's not based in the UK. We have a commercial team focused on anyone buying through a limited company or requiring bridging finance, whether in the UK or overseas. And then we have a private client team, and they're focused on the upper end of the market. So typically buyers who are looking to borrow more than £1.5 million, or who have complicated income structures, which includes overseas income, which it makes the process of obtaining finance much more difficult than it used to, but we have solutions there as well. If you can please tab on to the next slide. I mentioned before that we have offices globally. Our main office is in London. We also have an office in Singapore and in Hong Kong. And from there, we also support the surrounding territories. Please move on again. Yeah, and then one of the other things that we can offer through that global footprint that we have, one of the other things that we can offer as well as the products and the physical location is the language skills. We have brokers in the team that speak languages ranging from Mandarin, Cantonese, Russian, Arabic, most European languages. So the vast majority of client needs we can cater for, and we've got the products and the language skills to match. And then in terms of fee structure, we're actually a low fee broker and a no win, no fee broker. So we're only charging a fee of £250 on a standard mortgage. And we're only charging that on completion. International deals are slightly more expensive. Our fee is slightly higher to reflect the cost and complexity involved on our side. But again, it's no win, no fee. And please move on again. In terms of success, we have a 98% plus success rate in terms of arranging finance. So where clients say, yes, we'd like to go ahead with the finance, we're just under 100% success rate. The industry average is just under 70%. And as bizarre as it sounds, 1 in 3 transactions still fail to complete in the UK, which shows the importance of getting the right financial advice up front. We also have very high customer success scores, and we're currently rated as 5-star on Google reviews. And please move on again. And fine, so moving on now from Capricorn into the mortgage part of the presentation specifically. As Mark said already, UK property has historically always been a very, very safe asset. There's a lot of reasons that underpin that, including the trusted legal system and the very reliable buying process. Mark's gone into this in far more detail, but just to say that prices obviously are still increasing. The average house price actually hit 276,000 in December 2021, and we saw, and that year also saw the highest house price inflation since 2003. So the market is historically very strong anyway, and it's very stable and safe, and right now seems like a very good time for the market generally. And if we can move on again, please. So moving specifically now onto the mortgage side of things, what's important to note is that one of the things that's underpinning the buoyant housing market is a fairly buoyant mortgage marketplace. 2021, as well as seeing very, very high house price inflation, also saw the largest mortgage market since 2007. So the gross mortgage market was about £320 billion in the UK in terms of fresh money lent, which is the largest since 2007. And as well as being a large market with lots of liquidity, or possibly as a result of those two things, what you're also seeing is very low interest rates. And on the residential side at the minute, they're as low as 1.2%. And fairly relaxed criteria, not as relaxed as it would have been pre-credit crunch, but as relaxed as it has been at any stage since then. So you can currently get finance as high as 95% loan to value on the residential side. In other words, banks will only require you to put 5% in and they'll lend you 95%. However, in practice, 90% is probably a better starting point for most buyers due to the availability of rates and products and circumstances, but 95 is certainly available as well. In terms of loan to income, it's possible with a number of lenders again now to borrow up to 5 times income. and actually you can get as high as 7 times by exception. There's also a lot of government schemes on offer in the marketplace. This is aimed at UK nationals. This isn't for overseas buyers, but it is underpinning the market for everybody. So the government schemes are really good. They are particularly helpful for first-time buyers, in particular Help to Buy. And these can help to dramatically increase the purchase price limits that are on offer to those buyers. So they can increase the budget for those buyers. It increases liquidity in the market, and it underpins demand in the marketplace, which is good for all investors. And the UK government intends to continue supporting the market in this way, which is good. If you can please move on to the next slide. So now looking more so at the buy-to-let side of the market, there are 2 main ways at the minute in which you can buy buy-to-let, or rather make buy-to-let investments in the UK. One is in personal names and one is via a company structure. Just starting with the buy-to-let in personal name option to start with. Again, the main thing here is that the property yields are very strong and they're very stable across the UK. London has higher prices and consequently lower yields, but you're still looking at around 4% yields in London, moving up to somewhere between 6 and 8% in large areas of the Midlands and the North. And the relevance here is that yield effectively drives the borrowing limits. So the lenders will lend a maximum amount based on what the property is yielding. On a buy-to-let perspective, you can get standard personal buy-to-let rates from as low as 1.8%. So from an interest rate perspective, this is the cheapest way to buy a buy-to-let property. However, the flip side to that is it's not as attractive from a tax perspective. You no longer get tax relief on interest payments. That has been phased out over a period of 4 years. And from now on, there is no tax relief whatsoever. Vida touched on this earlier, but you do also pay a higher rate of stamp duty on buy-to-let properties than you would pay on residential properties. That table shows the relevant figures there. And it's also important to note that there is a further loading of 2% on top of those rates for overseas investors. The rates are different in Scotland, so I'm predominantly looking at the situation here in England and Wales, and Scotland is fractionally different. If we can move on to the next slide, please. So the other option for buy-to-let, one is to buy it in personal names. The other main option is to buy it in a limited company structure. These have become more and more prevalent, buying through limited company structures in light of the changes that have been phased in on the personal taxation side. So the tax treatment is far more favourable through a limited company. You do still get a form of interest rate relief. It's effectively an offset against the profit, but it's the same underlying outcome. And then SDLT and CGT rates are different as well. So they're all more favourable. So the headlines are that buying through a limited company is more favourable from a tax perspective. However, the interest rates are higher, and rates here typically start at about 3.5% versus 1.8, 1.9% in personal names. So what you really have to do here is compare the 2 things together, and also look at your own individual circumstances, your own aspirations, the timeline that you intend to hold the property over, what other assets you hold alongside the properties, and what you intend to do with them in the long run. And so it's important to look at all of those things. If you jump in based purely on tax or purely on interest rates, then you're not really considering the whole picture. There are companies now that help, because this market has grown. There are companies that help with the company formation side of things. We work alongside a company called Get Ground, and they can arrange the setup of the company structure for you from as low as £500 if you're overseas, or £149 in the UK, with an ongoing subscription fee of £20. But again, all of those charges need to be factored in alongside the company structure. So that's the buy-to-let limited company option. And then if we tab one more slide. So in terms of next steps, key questions: where, location is still the most important question in property. Where do you want to buy and why? In terms of the why, are you looking for a place to live in or an investment? If it's an investment, are you looking personal name or limited company? And then you have to consider, what can you afford? This is where we can help. So sit down with an advisor to work through all of this properly. When are you looking to buy? RPI is expected to top 5% in the UK this year. House prices are rising rapidly as well. So I think the sooner you can get on the ladder, the reality is it's probably a case of the sooner the better. Your Capricorn advisor can actually help you with all of these things alongside the guys at benhamandreeves. In the UK, mortgage advisors are seen as the first line of underwriting, and they can actually help you to get your credit report, confirm your affordability and mortgage eligibility, help you set the budget and get an initial approval to inform your search from there alongside your property agent. And then there's one final slide, I think. Here you go. So that's our contact details. That QR code there, if you were to scan it, it takes you straight through to Capricorn, and you can actually start the Capricorn advisor journey from there. And we actually have those elements I just mentioned in terms of the credit reports and income verification and fact finding, all available there. So that links into the Smarter 365 app, and it's the Capricorn version of that. So if anyone is interested in taking it further, they can do so via that QR code. And I think Mark and the team intend to send an email around following this anyway, so there'll be other contact details there as well. But thank you for your time, and I'll hand back to Mark.
Thank you very much, Connor and Vida. I hope everybody thought that was helpful and interesting. We have got a few questions. So if you want to ask them, then keep adding away at the Q&A area. I would say a couple of people have asked for certain slides, and I've responded to them, but after the event, all of the slides are available. It'll get sent to you as part of a post-webinar follow-up, so you'll have them all. So the first question, I think, which is quite interesting is, and I think this is for Connor actually, is one of the questions is, and I think a lot of people from overseas are worried of how do they, as an non-resident get a mortgage? And I think that's, can they get a mortgage, and how? I think you said they can get a mortgage, but how do they get it?
They definitely can, Mark. It depends on the territory that they're in. There are certainly some that are easier than others. Singapore and Hong Kong, very well-established markets in terms of individuals from there buying UK property, and so they are particularly easy. And then spinning out from there, it just depends on where you're located in terms of what the options are. We have options covering an option available. The only question then normally comes down to price. So where there's more options and more availability and more liquidity in the market, it tends to impact on the rates, and the reverse is always true, also true. And I would just say, feel free to reach out. We can have a look at your individual circumstances. And within normally 30 minutes to 45 minutes, we can narrow that search down and we can give you those specific options, and then you can take it forwards from there.
Okay, that's great. I mean, maybe Vida can answer this. I mean, we have a lot of clients. A lot of our clients are overseas. Obviously, 80% of our clients are overseas, and a lot of them are in Asia. So we help a lot of non-residents buy. But I think a couple of questions, and Connor did talk about it a little bit, buying into a company. But I mean, there's 3 or 4 questions about the best legal structure to buy a UK property for a non-resident. Vida, do you want to take that nice, easy question?
Yeah, sure. I think the first thing to do is to set out what your long-term goals are. It's important to have your vision in mind when you're deciding on the most suitable structure, because once you've actually purchased your property, if you change your mind later, it can be difficult to unwrap it. So that's the first point to bear in mind. As Connor mentioned, the most appropriate structure is really going to depend on your individual circumstances. So those need to be considered. But as a general rule of thumb, because we do get asked this a lot, we would suggest that if you are looking to build a portfolio of properties, then a company structure may be the most suitable solution for you, more as if it were a business rather than an individual asset. But if you are looking just for 1 or maybe 2 properties, then actually the tax differential is quite small. And so an individual name is generally simpler, and depending on where you're based, you may be entitled to certain allowances which a company wouldn't be, so which could be tax favorable for you. And as Connor mentioned, you need to consider, if you're taking a loan out, that interest rates in a company structure may be higher, and there will be administration costs in running that. So there are a number of different things to think about, but like I said, do make the decision early, because it can be difficult later on.
Yeah, I agree. I mean, we agree with that. We recommend, because a lot of people do get the personal allowance, and that can really help you on your income. If you have a loan and then personal allowance, if you're only going to buy one property, then we would generally recommend putting in a personal name, but more than that, not. Another interesting question, maybe both of you can get that, is maybe both of you can help with this, is what's the lowest I could invest if I want to get on the London property market? I don't have loads of savings. So a couple of people asked something similar, but one person asked that. Connor, is there any minimum value to get a mortgage, or?
I mean, this would very much depend on individual circumstances. UK national, based in the UK, in theory, just
non-residents.
Not for non-resident. The challenge non-resident side typically is that most lenders will have a minimum loan amount. And so this is in the international marketplace. Lots of the minimums are set at 250,000. There are 2 lenders currently that will lend as low as 100,000. Okay. So in theory, you can borrow 75% of the purchase price, and a minimum loan of 100,000. Therefore, the minimum purchase price becomes £125,000. Yeah. The question then becomes: is it possible to find a property in London for 125,000? I think the answer to that one is no. But there might be areas of the north where you can do that, and there might be areas where the yield is quite strong. But I would say in London it's probably unrealistic, but more so from a property perspective as opposed to the finance.
Yeah, Vida, the same.
Yeah, I don't really have anything to add to that for non-residents, but I would just mention again that for UK buyers buying their own home, the Help to Buy scheme is incredibly beneficial, because the government effectively help finance an additional 20% of the purchase price, which can mean that you can buy a property in a new build in London with very little upfront cash actually that to get going.
Yeah, and I agree. I mean, if someone wants me to tell truthfully, if you're a first-time investor, you should really, we would drive people to London market, and the cheapest you're going to find something is going to be in circa £350,000. So if you get 75% on that, then you're looking at about £100,000, give or take, that you need to have there. Any less than that, it's going to make it very difficult, and things are going to be really tight, because you might have to pay service charges and things like that. So I would, £100,000 is going to be the minimum, and the cheapest property is going to be circa £350,000, £400,000. So this is interesting. I have £100,000 profit in a property. Again, this is for Vida. In a buy-to-let property in London. Is there anything I can do to avoid capital gains tax? And what do I do in terms of inheritance tax? I think actually tax is an interesting area, but maybe you want to have a think, maybe you could answer that, Vida.
Well, from the capital gains tax perspective, I think you said it's owned in a company name, is it?
It's in a personal name, I think.
It's in a personal name. Well, you can't really hide away from capital gains tax, but there are a few things that you can consider. The first is that make sure you're making use of your annual allowance. Every owner will have an annual amount of capital gain that is tax-free. When you're calculating your capital gain, make sure you're including all your buying costs. And if you've done refurbishment to your property since you've owned it, then those can be included as part of the cost when calculating the gain, and will obviously reduce the amount of gain and tax payable. There are other things. If you can sell in a year in which your income is lower than it would be otherwise, that can help you out, because you'll pay the lower rate of capital gains tax based on the amount of income in that year, which is 18%. Once you go into the higher levels of income, you'll pay 28%. So timing can be important as well. So it's a question of just understanding what all the rules are to make sure you're taking advantage of all of them.
And the other thing, I think one thing to add to that is, I had an inquiry this morning, is if you own a property and you've owned it for some time, capital gains tax sadly came in for non-residents in April 2015. So if you'd owned it before that, you would want to get it revalued to the value at April 2015. And if I look at it, there's been not huge gains, generally speaking, in the market since 2015 to date. There's been some gains in different pockets, but generally the growth has been flat. So if you've owned it for a while, I get it revalued, and that's likely. I would be surprised if it doesn't wipe out the capital gain. So another couple of questions surround about the talk that I did are one person said the rental yields presented are gross yields. Given I'm an investor living outside the UK, what's the net yield in general after factoring in all of the costs, management fees, rental of the property, upkeep and maintenance? So as a rule of thumb and as a really basic guide, we say that you should allow 1% for costs. So if your yield is 5%, that would give you approximately a 4% net yield. Again, if it's 4% and 3%, and then as the returns get lower, then obviously the percentages reduce. But anywhere between 5 and 6% as a rental yield, gross yield, you should see about 1% lost in costs. So it's quite difficult. And if you've got an example, we can run it through. That's what we're here to do, to help you and help people. We have offices overseas, which I don't think we really mentioned. Connor did, obviously. He has people around the world helping with mortgages. Equally, benhamandreeves, we have 18 branches in London, but we also have them in Hong Kong, Singapore, KL, Dubai, Shanghai, and India. So those and South Africa as well. Those local teams are there to help you with your queries regarding a London purchase, the costs, the fees, the charges, what I have to pay, what I don't have to pay. It's quite complex, and we're happy to help you. And that's what we're here to do, is to guide. But as a rule of thumb, it's about 1%. So another person did ask just now is where's it gone? Sorry. Can you use Help to Buy for buy to let? I don't know, someone mentioned Help to Buy, but can you use that?
I mentioned Help to Buy. Help to Buy is a scheme for homeowners. It's not for investors.
So you can't. The answer is no.
Yeah.
Okay, perfect.
I am hearing that there are other schemes coming available through other institutions, which are basically designed to mimic the Help to Buy scheme, but will be available to anyone. And so it may be worth keeping an eye out for those kind of suggestions.
That's definitely correct, guys. Just to pick up on that from Vida, that's definitely correct. There's been talk previously of Help to Buy being withdrawn, although it keeps being extended. And so there are privately funded operations that have looked at that space of the market and said, we could fund what the government is doing and do it as a business and make money from it. So there are definitely privately funded versions of that coming, which will be more flexible from a criteria perspective. They're unlikely to be as generous from a financial cost perspective as the government one, but there are other schemes coming there, so that might definitely help on that side. Okay,
great. No, I think it's interesting, yeah, but you can't. The Help to Buy was actually to help British people get on the ladder, as opposed to British people or non-British people buying properties for investment. A lot of people have asked this about what is the best way to buy a property, and I think we've answered it, but if you're moving to the UK, what's the best ways of buying a property in the UK if you're moving here?
If you're moving here, Mark, I would say personal name with residential finance.
Yes, if it's going to be your home, it's not advisable to put your own home in a company structure due mainly to the annual tax on envelope dwellings that we mentioned, because you could be liable for a huge amount of tax as a result of that kind of arrangement.
The lender would also prohibit you from living there, Vida. So if you owned it through a company structure and rented it back to yourself, most lenders would prohibit you from doing that.
I guess for a cash purchase, people may or have in the past looked at it. In fact, that's why the ATED came in, because people were buying their own homes and putting in the structure, I think essentially to save stamp duty on the subsequent sale, but that is frowned upon, and it's really not appropriate.
No. So thank you for that. Another question interesting is do you also help with resale homes, and would you recommend resale home over a new home? So I'll quickly do that, and maybe you guys can add some stuff on loans or whether it affects anything from a tax perspective. But yes, of course we help with resale homes. So if you own something that you want to sell, whether you bought it off plan or where you bought it secondhand, we absolutely can help you sell it. But if you've bought it off plan now and you think prices have gone up and you want to sell it before you can complete, I said in my bit at the beginning, it's a very hard thing to do. And you are unlikely to see a gain. Whatever the developer is selling for, you're unlikely to. Buying property is not an in and out thing. There are costs, and it is a longer term purchase, but it shows very strong returns, which I showed. But yeah, we can absolutely help with resale homes. Or secondhand. The question about whether you should buy a secondhand property, i.e. a resale, or you should buy an off-plan property, my view is you look at what your criteria is. The advantage with buying an off-plan property is you only pay 10% when you negotiate the best discount you can, or we do that for you. You pay 10% on exchange, and then you pay maybe another 5 or 10% before completion, and then the balance is on completion when you get your finance. So you have anything from 2 to 3 years to find the money, number one. So number two, during that 2 to 3 year period, there may have been some capital growth. So you could see some benefit of growth that the market has done for you. And number three is that a lot of people don't take into account that there will be some maintenance. Properties sadly go wrong. You have leaks, broken washing machines, and things sadly do go wrong over time. But if it is brand new off plan, the first 2 years you generally will have a warranty. And if everything's brand new, it's going to last that bit longer. If you buy secondhand, London is a very old city, as everybody knows, and properties go wrong, and we do have maintenance on older properties. There's lots more maintenance that you need to factor in. But we would generally recommend new build because it's easier, it's simpler to buy, you agree the property, you sign it. And so that process is, again, a lot simpler because you don't have to instruct a lawyer, and then it could fall through. The seller could change their mind, he could want more money, or he could just sell to somebody else. There's no lock-in, which you get if you buy a new build. So yes, we can help, but generally for first time or beginning investors, we tend to recommend brand new build. But then obviously it's down to your preferences and what you want to do. If you want to own a really nice red brick Victorian building, a flat in that, we can help you with that. But that's not our typical recommendation. Is there anything to add on that from a mortgage perspective on borrowing on second-hand homes?
Not really, Mark. To be honest, the differences between the two are so minimal, and for most lenders, there's no difference at all. So I'd say there's no real finance implication, and therefore it really is down to personal preference and the factors that you mentioned there, Mark.
Yeah.
Maybe from a tax perspective, there's no difference. So again, it's more about personal preference. What I would maybe add is one of the benefits of new developments is the community aspect and facilities. And as you mentioned in your talk earlier on, thinking about what tenants want is crucial when taking an investment property. And we do find that security facilities, ease of everything tends to favor the new developments. But there are people who prefer to live in a more traditional building, and so that has its own merits. It's just thinking about what it is you're looking to achieve.
Okay, good. I think that's very interesting. What tenants want is really important, because if you get what you want, they're going to pay more rent, and then and that will help your investment. But obviously there are costs for those facilities. But again, we can help you. We're at 11 o'clock, and we've got still quite a lot of people here. So I'm just going to take a couple of final quick questions of, if I already own a property and I'm thinking about buying more properties, should I do that in a company? And I think, Vida, you said yes, right? If you're going to buy multiple properties.
Yes. Well, if you've already purchased a property in a personal name and your goal now is to build a bigger portfolio, then I would suggest that your new purchases be in the company name. The difficulty that the investor may face is wanting to transfer that personal property into the new company structure, which will have some tax implications. And so that is a reason for really looking at your goal at the very beginning and not partway through the process.
Okay. And obviously that affects the mortgage rate, as you discussed anyway, Connor, and you said what the rates are. It's slightly more expensive to be in a company.
Correct.
Okay, I think this is the last question, because actually it's quite interesting, and we do get asked an awful lot from Asia. What are your views on landed properties? So I think I talked a little bit about secondhand. Landed for us means with a freehold, because if you own a flat in a block of flats, you generally have a lease. Landed property means you own the whole freehold. What's our view? Connor, I don't think it makes any difference in mortgage on a freehold property, does it?
It doesn't. There normally would be an underlying lease anyway. And so in terms of the structuring, if you buy a house on freehold. Sorry, if you buy the house, sorry, in that case, no mortgage, certainly no restrictions. If anything, where there's any difference at all, it marginally favours freehold property. But in practical terms, the difference is so slight that there is no real difference.
No, there's no other
negative. No, I mean, it obviously, as we've said a couple of times now, it's really personal preference. For me, if I was buying my own home, I would prefer a more traditional property. If I'm buying an investment, I think the new build makes everything a lot simpler, and that's probably what I would go for investment property.
Okay, so last question, because I think this is interesting. So a couple of people have asked, should I buy Manchester or should I buy London? So let's put it that way. Let's not do Manchester, because that's being very, very, very specific. So would you buy, if you had a choice, you can each give your one word on, would you buy in London or would you buy outside London? And very quick why you would do that, because we're running over. Vida, do you want to go first?
I would definitely always buy London. It's just a more established marketplace. And for me, property is meant to be a low risk, stable investment. And I think London offers that best opportunity.
Great. Connor?
For me, I'd say London for capital growth, the North for yield. And if I was doing it personally, I'd probably go with London for the same reason that Vida said. I'd be looking at the long term, which is more growth focused, and therefore for me, London.
Yeah, and to be fair, I agree with that. I would only buy in London. I mean, I did try with some overseas stuff. I did try Malaysia, and it was a terrible experience. And I did have Brazil as well, and it was it's so far away, and it's not like we are as agents looking after people's hands. So I think London, outside of London, as Connor says, the yields can be higher, but there is extreme amounts of growth going on in some of these places. And if you end up with oversupply, then that's going to heavily affect what's going on in the rest of the market. Whereas London, there's never enough stock. There's never, we in the UK and in London underbuild on an annual basis. So there's always going to be strong demand here. But anyway, we've run out of time, and thank you very much for everybody joining. Our details are on the slide. If you have any extra questions, by all means, send it through. We will try to answer them. If it's for Connor, I'll forward Connor's email on, or I'll forward it on to Connor, so you can ask them on your mortgage questions, or Vida equally on tax or the process. Other than that, it leaves me to thank you very much for joining us today, and I hope you found it helpful. Our next webinar for part of the Power Hour is going to be for a post-budget update. The Chancellor's statement is in March, and straight after that, I'm going to host a session with a well-known journalist who's going to give his ins and comments on that. So we'll circulate that information nearer the time, but that will be our next one. Anyway, and thank you to everybody for joining, and thank you very much, Connor and Vida, for your comments today. Thank you.
Thank you.
Thank you. Bye-bye.
Thank you.
Bye.